Hi, good morning, everyone. Thanks for coming out. And I have to apologize for my voice. I did a presentation yesterday and I woke up this morning and my voice is not doing so great. I feel fine, but my larynx is messed up. So sorry for that. Okay, so let's get started. And like Jody said, we'll keep this pretty interactive. If you have any questions, just go ahead and, speak the question and we'll talk about it. Okay, so first, see here if this works, hopefully. Yeah, so, okay, so I want to go over, let me back up a little bit. I'm not sure how many of you are familiar with New American Funding. That's the company I work for. I'm a loan officer, loan consultant with New American Funding. We are a nationwide lender, so we're a mortgage lender, and we lend in all 50 states. We have all the loan programs, all of the standard Fannie Mae, Freddie Mac, FHA, VA, USDA, all the government loans, all the agency loans. But today, I'm not really going to talk about those because I think, well, hopefully we're mostly familiar with all of those. And we're going to go over some different loan programs and different strategies than those. So first off, a little bit about us. I just want to kind of do a couple slides here to toot our own horn. We have 297,000 5-star reviews, 4.9 to 5-star reviews online. So we really do our very best to create a great experience for our customers. And then just another one, these are testimonies for me personally. And easy communication. Jed was always available to talk 24/7. So, okay, so that's it for the sales pitch. Next, I'm going to talk about, let's go over interest rates and kind of where the interest rate markets are right now. And I want to go back to what Jerome Powell, who's the Fed chairman for the Federal Open Market Committee, and the last meeting that took place on January 31st, he made this statement during the press conference. And he said, so somebody asked him, one of the reporters asked him, when do you think you're going to be lowering interest rates? And he said, well, actually, specifically, are you going to be lowering rates, cutting rates at the next meeting in March? And his response was, based on the meeting today, I would tell you that I don't think it's likely that the committee will reach a level of confidence by the time of the March meeting to identify March as a time to do that. But that's to be seen. So why he couldn't just say, no, I don't think so. He had to, he had to make it kind of long. But the reason I want to point this out is because, if you're thinking about where interest rates are going to be moving in the next quarter and the next half of the year, Jerome Powell is pretty much saying, look, we're not going to be lowering rates anytime soon. We're not going to be cutting. And I know like the stock market and the investment markets have all priced in. They were expecting rate cuts earlier this year, but it looks like we're not going to get that, unfortunately. However, a little bit of a silver lining. This last word here, or this last phrase, but that's to be seen. What that means is if the economic data comes out showing that the inflation is continuing to fall, which we didn't see earlier this week, and if the economy starts to slow down, that will give them the ammunition they need to start cutting rates earlier. But just to kind of set the right expectation for everybody, I don't think rates are going to be moving downward very soon. And this is a picture of the inflation numbers just really quickly. So this goes back to, I think, 2019 here. And you can see we reached a peak at the top here in 2023, just before 2023. And we have been coming down, which is a great sign. Mortgage rates are really tied to the inflation numbers. So as inflation comes down, mortgage rates will come down also. So I just wanted to give you kind of a little bit of a history on where the inflation numbers have been. And then the January jobs report came out, the pink or red line all the way on the right-hand side there. That was the jobs report that came out for the month of January. And it was much, much stronger than the economist expected. So what does that mean? How does that affect mortgage rates? Well, when the job rate is strong, that means everybody's making money, everybody's employed, which means they have income to spend on goods and services. And it means they can, pay higher prices for goods and services. So higher prices means inflation goes up. So this latest jobs report is part of what's giving Jerome Powell his statement of we're not going to be cutting rates anytime soon. So, Okay, so the average 30-year fixed rate. Let's take a look at this. This chart goes back for 1 year, back to March, or actually February and then March here. And you can see a year ago, we were down in this is the 6% line right here. We were down just above 6%. And then last fall, October, November, we walked all the way up to just that 8% range. Okay, so it's pretty high. And, recently we've seen it come down to, I wonder if this has a pointer. I don't think so. We've seen rates come down to, right here, this level is just maybe 6.625. And then since December, we've seen rates kind of come back up. So we saw this rates coming down, and we all loved this section of the curve right here. We're like, oh, great, let's keep going. But rates did reverse, and it's been a little bit jagged. And you can see this is the average. This is the 7% line. So the average 30-year fixed rate just above 7%. So when you're talking with clients, new buyers, or even homeowners, and they ask you what's happening with interest rates, this is what you can tell them. The average rate is right around 7%. Now, for some people, depending on credit score, down payment, property type, and occupancy type, the rate's going to be different for everybody. So, okay, let's see. Okay, before I get to that, I was going to show one other. Are you guys okay on rates? Or there's one other chart I wanted to show, and I got to do. This one's online, but just to give you some expectation of where rates are. Yeah, this takes a second to come through. And what this is the CME group. It shows probability of the Fed funds rate. And this is the probabilities for the next meeting in March. And if you look at, can you see my pointer? Yeah, right there, the 525 to 550, that's where we are right now as far as what the Fed funds rate is concerned, as far as what the Fed funds rate is. And you can see there's at the top here, an 89.5% probability that the Fed will keep this rate the same at the next meeting in March. Okay, there's a 10% chance that they'll lower the rate by quarter in March. So this is just kind of gives you an idea of this. This is based on the futures markets. So what investors are expecting to happen with the Fed funds rate. And then if we click on the next one, the meeting after March is going to take place in May. And you can see the numbers change a little bit. There's a 62% chance that we'll keep the rates the same, and a 34% chance that they'll take the rate down a 0.25%. Okay. Now these change every day. A new economic report could come out tomorrow, and these probabilities will adjust based on what the investor community is thinking. So I just wanted to show that just to kind of give you a probability, an idea of kind of where we think rates are going to be moving. And let me go back to the presentation. Oh, yeah. Yeah, yeah. I know. I don't like talking about that. That was rough. That was a rough day. Okay. Let's see. Hopefully this comes back online. Yes, it does. Okay. So let's go. Okay. So now I'm going to start. We're going to change subjects. I'm going to, stop talking about mortgage rates and move into kind of some of the financing strategies that we have available that I wanted to talk about today. And the first piece that I want to talk about is this equity line of credit program. And this is really kind of a key piece for a lot of the advanced strategies that we're using. And this is what's really nice about this program is I put in red here, they will go in third position. So I'm not sure if I'll kind of explain what that means. When you take a loan, the mortgage loan is recorded on title to the property as a lien. And most lenders want to be in first position. And what that means is if there's a default situation and the lender needs to foreclose, the lender in first position gets paid first when they sell the property. And then if there's a second loan on the property, if the homeowner takes out a second loan, that second loan will go into second position. So what that means is if the property is taken back in foreclosure and sold, the first lender is paid. And if there's any money left over, then the second lender has second priority. So they'll get paid. And then it goes down the line. And then the third lender, the lender in third position, if there's any money left over, they get paid. It's pretty unique that there are a lot of home equity line of credit programs do not do a third lien, but in this case, we can. So this is, and just kind of keep this program in the back of your mind, because this is like a piece of the puzzle for some of these strategies.
Probably not higher interest also, right?
Yes, they are higher interest. Absolutely. Yeah. And okay, so this is the really amazing component of this particular loan program, is that they will actually write the loans for second homes and in rental properties, which is very unique. Most home equity line of credit won't do that. Yeah, this is cash out. Yeah.
Maximum 250.
Yeah, max loan amount is 250,000. Yeah. Yeah, it's not, I mean, it's not a million or great, but for investors that need to liquidate some equity in their second home or their rental property, I shouldn't say investors, like any consumer. The other really great thing about this particular program, I didn't write it here, but they will write the loans even if the property is listed for sale, which is also very unique. So if you have a property that's listed for sale, they'll do the loan. And so we have customers that need to, spruce up the property, before they bring it on market, or maybe there's an issue with, the loan and they need some money to make some repairs or something. So that's a really nice feature of this program. Now, you might be thinking, well, how can they do that? Here's the thing. They don't just do it for free. They do charge upfront fees because the lenders want to make money, and they know if they're going to write a loan on a property that's listed for sale, it's going to be sold soon, which means they're not going to receive many interest payments, right? So they charge, points up front to do that. So these are not the greatest interest rate loan programs, but they're short-term. They're really designed for short-term use, and they can help a customer sort of, get over a hurdle or move in the direction that they need to. It can be used as a bridge product, yes. And actually, that's what I'm going to talk about. Yeah. Okay, so here's how this works. So this is another really unique program that we have that we would couple with that equity line. So what happens is we have a move up buyer situation here. We have a home, the customers own their home and they have some equity in their home, like most homeowners that bought, in the last 10, 15 years, if they haven't leveraged it too much, property values have been going up. So there's a lot of people have equity. So the idea here is the home that they currently own, they would use this home equity line of credit to liquidate some of the equity, to liquidate some cash, so they can use that as the down payment on their next home. And then the next home they use, and the difficulty in doing that in general is most lenders will qualify the borrower with 2 housing payments, which makes it difficult. So, they have to qualify the borrower with the housing payment that they currently live in, and then also the housing payment that they're looking to purchase, which means there's lots of liability there. And so you have to make, the customers, in order to qualify for that, they have to make a lot of money. Their debt to income ratios have to be in line. But the unique thing about this program that we have, it's a NAF portfolio program. This is a proprietary program that we have. We have a set of investors that will allow this. And the homeowners, what they have to do is, if they write us a letter saying that we intend to sell this home after we purchase our new home, our investor will not include this housing payment in their eligibility in qualifying them for the home they purchase. So the idea is this: you take, that equity line of credit program that we just talked about, and yeah, the rates are not great. They're in the 8 to 10% range. Okay, and points, there's several different factors. You can pay like 2 points and up to 2, 3, and 5 points. And depending on how much points you pay, the interest rates are different. And then they have different amortization periods. That one gets a little complex as far as the kind of, yeah. But it's not as expensive. Hard money is a little bit more expensive. And so the idea is you liquidate some equity here that can be used for the down payment to purchase that home. The homeowner or the buyer in this case, they say, yeah, we intend to sell this property, but now they can actually purchase this property. And the real kind of the beautiful thing about this is, of course, we have to pre-approve them for this whole strategy. But as an agent writing an offer, now you don't have to write the offer contingent on the sale of this property. And I think that's really huge, because what happens is they can live here, they can buy the home, they can move in, right? And now this one's vacant, a little bit easier to sell. And then they can sell this home. And when this home sells, they pay off the home equity line and any other loan they have on that property. And then if they have, sales proceeds left over, they can pay down that mortgage as well. Okay. So that's how this one strategy kind of works to enable a client to write an offer without being contingent on the sale of the current home. And because we know I think in Santa Clara County in particular, it's crazy right now. Multiple offers, and buyers are really struggling to compete with each other to buy a home. It's not so easy. So, any questions on that one? Yeah.
Writers.
With what?
Writers. A lot of times they have like 2 or 3 months to not work, and when they write it up, get something for them. How would that work?
Oh, okay. A writer, yeah, where their employment, what they do for a living is they write, and kind of like on a contract basis.
Yes.
Yeah. In that case, most lenders are going to want to see a 2-year history of the income that person has generated in order to use that income as qualifying income. So that's a little bit unique. I'd want to see the tax returns, and they're probably paid on a 1099 basis, I imagine.
Yes.
Yeah. So we would need to see those, and maybe some contracts, if they're involved in a contract currently. So that kind of documentation would be needed. Yeah. Yeah. Okay. Any questions on this one? I'm going to move on. Yeah.
So in that case, they're buying on the property, you're going to provide the purse and then the money that they're putting as a down payment. The first one, then you will purchase.
Yeah. Yes. That's the first loan for the purchase here is this program. One of the features of this program allows this family to qualify for this loan without including this housing payment. And that's kind of the key piece there. Okay. Okay. I got ahead of myself a little bit. Yeah. So this is kind of the non-contingent offer piece. We write the home equity line of credit to liquidate some of the equity. Now they have liquid cash available to inject into the next purchase. And we use this program to qualify them on the purchase loan. And so then this enables them to write the offer without it being contingent on the sale of their current home.
What kind of interest rates are you talking about, say today?
Yeah, today. So the equity line, those are going to be between 8 and 10%. And then this loan over here, this non-contingent, the first loan, that's going to be in the 7 to 8% range, depending on credit score. Correct. No prepayment penalty. That's right. Yeah. Neither of these loans have prepayment penalties. Yeah. Most loans today don't have prepayment penalties. That was a thing in the, prior to 2008. Lots of loans had prepayment penalties. That was a different lending environment back then. So, okay. Okay, so I'm going to start talking about another loan program now. We're going to move on. Another program that we have, we call it NAF Cash. That's what we call it. NAF is New American Funding, and then we call it Cash. And just a quick overview, what this program enables a buyer to do is to compete with an all-cash offer. Now, this one's a little bit more complicated, so just stop me and we can go over any questions you have. So first off, step one is we do a pre-approval for the client using this program. And the pre-approval is just like any normal pre-approval. We take a look at the income documents, the asset documents, credit report, and we pre-approve them. Then once they're pre-approved, they can go shopping for a property, right? Just like normal. They find the property that they want to purchase. they make the offer, and they can negotiate the offer, like the price. Like the client says, hey, this is what we're gonna, so you as the buyer's agent, you help them establish the offer price. And then what happens is we open the first escrow. So this program involves 2 escrows, okay? So the first escrow is opened. So this is the seller accepts the offer. So the first escrow is opened. And what NAF Cash does is NAF Cash comes in and buys the property for all cash. So we come in and we say, okay, we buy the property, and escrow closes. It closes, you know, the seller has, you know, their money so they can go do what they want to do. And now NAF Cash, we own the property. So what do we do with that? We lease it back to the client. Yeah, so we lease this to the client. So now the end buyer, the client, they can move into that property. They can legally access it because there's a lease agreement in place. So they lease the property, and then at that point, we open the second escrow. Okay, we open a brand new escrow, and we do the underwriting. We've already pre-approved them for this stage, but you know, we go through the full underwriting process and underwrite the loan for them to buy the property from us.
Are you paying closing costs twice?
So no. There's the closing costs on the initial escrow. So yes, there are 2 escrow, like the escrow fees. Yeah, 2 escrow fees.
Tax.
Transfer tax, city tax. That's,
Yeah.
now on the term, going back to when you make the offer.
Yeah.
You can put in all cash, right?
Yes.
But you don't have to qualify it. So if the client want to make an offer, no contingencies, assuming you've pre-approved,
Right.
they can go all cash, no contingencies, no problem.
Yes.
Well, they're gonna need, usually they ask for proof of funds, so how does that work? Do you guys give us your bank account that says?
Yes.
All cash or?
Yes. So let me back up just a little bit. This program, there's a ton of details on this program. I wanted to just kind of give you an overview so you have a very high level on how it works. Okay, and that's how it works. You know, from a very simple standpoint, client identifies the property, we buy it for all cash, we lease it to them, and then we do the loan for them to buy it from us. Okay, so that's the overview. Now, in order to make this work, what happens is the buyer's agent, we actually do require the buyer's agent to go through a training with us, because what happens is this contract that we write to buy the property, this is going to be in the name of NAF Cash, not the buyer, because we're taking possession of the property. Yes. So our company, right? So we're going to buy the property, but like going back to this is we don't establish the offer price. That's, you know, you work with your client, with the buyer to decide what the offer price is going to be. And then we will write the contract based on that price. And this is not a free service. Okay. We don't do this for free. The fee is 1.6%. So the way the fee works is, let's say we have a $1 million purchase. Okay. We write the contract for $1 million. The seller accepts it. We go in and buy the property all cash for $1 million. When the client buys the property from us, they will buy it for $1,016,000. That's the fee. That's the 1.6% fee. Right. 1.6. Okay. Now, the other component to this is, you know, we know here traditionally we bring in a 3% initial deposit. So who does that? We require the buyer, like our end client, to bring in the initial deposit to the first escrow. The reason we require that, even though we are purchasing the property, is we don't want them to get cold feet. We don't want to take possession of the property and have them say, oh, we changed our mind. You know, so we want them to have some, you know, skin in the game. So they're going to bring in their 3%, and that money is just transferred to the second escrow. So it's applied to, you know, the purchase. So there are some other details as far as, you know, kind of the logistics on how all this happened. The main thing is the training for the realtors.
Well, they're doing all cash, so it doesn't need appraised.
Well, but it does need to appraise. That's a really good question. We do an AVM on the property before we write the offer, because we want to make sure that because we're going to fund a new loan that's going to go to any investor. It could be a Fannie Mae Freddie Mac loan. It could be, it cannot be an FHA loan just because FHA has a flipping rule. So we can't do this with FHA, but we can do it with VA, with, you know, Fannie Mae Freddie Mac loans, and then the jumbo loan programs too.
So you do ABM, is that your own proprietary or
Yeah.
third party out there? What do you use?
Yeah, so we have an appraisal management department. I actually don't know. I would have to talk to them.
Current,
Oh, yeah.
all these ABMs will give you know, range all over the place.
Yeah. Well, we do a lot of these. And so
In the valley?
in the Valley, yes, but more so in the East Bay. Yeah. So there are some limits. We will purchase up to a $2 million property maximum. But then the maximum loan amount is the conforming loan amount, which is at 1.143, I think, right now.
Before we make an offer, we need to go to you and get the ABM on that property, make sure that.
Well, we will do that. Yeah.
Before we make an offer.
Yes.
Okay.
We need to know the property address, and that is part of the training. Like, you'll learn a lot about that if you go through the training. So.
What's the time frame for this?
So the first escrow, we can close in 2 weeks or shorter because it is legitimately in all cash. And to go back to the proof of funds, we provide a statement with the proof of funds. Yeah. So the seller sees an all cash offer. Yeah. So the lease, we like to keep that as short as possible.
Is this all predetermined?
Yes. Yes. So the clients know exactly what they're getting into in terms of the entire, so this pre-approval process is a little bit more involved than just a normal pre-approval. So, let me get, he got a question here.
A really important question.
Yeah.
As a realtor, do I get paid twice for 2 closings?
No. Yes. I mean, I'll talk to our guys about that. Maybe. Yeah, but that's a good point. You actually, the realtors get paid when this one closes. The first estimate. You're kind of out of the loop. I mean, you probably want to stay and, you know, communicate with your customer just for, no, okay. But,
Time frame, you say as short as possible, but are you talking 3 months to have the second escrow loans?
yes, 3 months. Yeah. And then after 3 months, the rent actually increases. So, yeah.
What if they want to go through a different company in the back end instead of your company? Are they required to go through you to get refinanced?
Yes.
Okay.
We do the purchase loan. Yeah. Yeah, we do the purchase loan. So
You said you just have to take the class. Is that the class that you do monthly, weekly?
no, it's an online, we can do it, you know, online. It's a Zoom class, and we have a roster of all the agents that have completed the course. So once you've completed the course, then you'll have an understanding of how the contracts are written and the contract form and all that. So. Pardon? Yeah. It's like a normal down payment. So if the clients are, you know, using 20%, 25%, you know, 10%. Yeah, we learn this here because we pre-approve them to go through this entire process. Really, what we're doing is pre-approving them for this funding. That's our main concern because we want to make sure this loan is a doable loan because, you know, we're gonna set out, you know, $1 million, whatever, you know, we're gonna, you know, that money's going to leave our account and we want to make sure we can get it back on the purchase. So
at least based on your
there's a schedule, there's a rent schedule, and that's part of when we do the pre-approval, depending on the terms, you know, we can show you what the lease, what that rent is. Yeah.
I have a Zoom question.
Yep.
How long can they lease it until they try and buy it back?
So like roughly 3 months. I mean, we'll work with the clients if, you know, the idea is this can also be used as a bridge loan for the client who has a home to sell. Okay. So, and again, you don't have to write a contingent offer. You know, we can come in and buy the property for cash. Okay. We lease it to them. So now they can legally occupy the property. Now their home is unoccupied. So it can, you know, be prepped for sale. Once that home sells, then now they have their sales proceeds that can be used for the down payment on this loan to buy it from us.
How about investors, flippers, or people who want to rent? You guys loan investors?
No, so this is primary residence only, and it doesn't do units. So
Also, no duplexes.
no duplex, triplex, or fourplex. No second homes, just primary residence and and condos.
Townhouse.
Townhouse condos, yeah, so. There's a schedule for the rent, and it depends on the, the purchase price, and I mean, I can share that. I didn't bring that today, but when you go through the training class, you'll see what the rents are. Yeah. And it's a short term, it's maybe, 1 to 3 months for the rent.
Not the insurance, stuff like that. They, from day one, they're responsible for the insurance of the house, is that right? Or, because you're the landlord.
Yeah.
So on the first round, who pays for the insurance? They do or you do?
They do. Yeah. Yeah. So.
Do the payments made during the lease term contribute to the overall?
Yes.
Cost of
Good question. Great question. And yes, they do. Yeah. So
they make the initial offer in the first pre-approval. Will that price stay set when the second loan comes through? That's under contract, or is that subject to that?
So the initial offer price stays the same, but there's a 1.6% of that fee added to it. So like if the offer's $1 million, 1.6% is 16,000. So they would purchase the property from us for 1,016,000. And that, yeah, so that's how we get that. Yeah. So
we as realtors would go through the training and then work with our clients to have them purchase this way.
Yes.
Or just to be pre-approved.
Just to be pre-approved with it.
Okay.
Yeah, for this particular scenario. And I've run into the situation where, I've had a client where, we're all set to go. Everybody did the pre-approvals, and they were ready to use this program. And then the seller, just based on the dynamics of the seller, we didn't need to use this program. So even though we're fully qualified and pre-approved, this particular case, they could just use a regular loan. The seller needed a lot of time. They didn't need a fast close. So we ended up not using the program. We just went through a normal purchase. So it's flexible. You don't have to use it if the terms, let me get him really quick. Yeah.
Are the lease payments in that 1.6% fee, the 16,000, are all those fees included in the loan somehow, or are they paid by the seller as he's going through the process?
Yeah, the client makes the lease payment.
Paid monthly?
Weekly. Weekly. Okay. And then the 1.6% fee, remember, that's added to that purchase price. Yeah. It's part of the loan. Yeah. 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 Yes. Yeah.
Two questions this time, really simple. One, what premium are they paying on the back end? They have that. Is there a higher interest rate, higher points?
No, it's just a regular loan program. Yeah, it's just you just know FHA, and it's at market. Yeah, yeah.
They're in second month of the lease, they get laid off, fired, whatever. What happens?
That's a problem. That would be an issue. I would have to talk to our underwriters and see how they would handle that. Yeah.
Right now, a lot of things are going up.
Yeah.
Getting laid off here and there.
Right. That's a good question.
You don't have any kind of.
I mean, like in a first, let me try to think through it here. So like on a normal purchase, if we're in the middle of escrow and somebody gets laid off, I mean, the transaction is done. We have to cancel. Yeah. Yeah. Now, in this case, there's a lot of risk for us if we acquire the property and then, we acquire it and then the client gets laid off. I think, hopefully they could get a new job. We would have to extend the lease and wait for them to get a new job so they have the income to qualify for this. It hasn't happened to me and not to my knowledge, but I would have to ask our, corporate.
Just keep leasing the property.
I mean, yeah, it's a lease. Yeah. So.
Just to be clear, you're buying the property that the buyer is going to buy, not the one they're going to sell.
Correct. Yeah. Yeah, that's it. This one is really all about the property that the client wants to buy. Because, as the buyer's agent, you're going to show them property and they're going to, find one they want to write an offer on. And then, you structure the offer just like a normal offer. If you need contingencies, or actually we don't have contingencies on this, but if you need a time frame, whatever. So.
me again.
Yeah.
On the back end, we're talking about now, how long does the loan have to season before they can refi through somebody else?
So this is a normal loan. This is just like, think of this as like a Fannie Mae, Freddie Mac loan. There's no prepayment penalties. This is not a special, this second escrow, the loan that they use to buy the property from us is not unique. It's just.
There's no seasoning.
No.
They can refi at 8/31.
Yeah. The only, like I said, the only restriction is you can't use FHA financing because FHA has the flipping rule. So you can't transfer title to a property within 90 days for FHA loans. So.
Question.
Yeah.
After a client moves in and sees issues in the house, NAF fixes them?
Ooh, very good question. So in this first escrow, we do get an inspection report. Okay, so this first escrow, and we will clear that with the clients. You know, just because we're buying the property doesn't mean the client's out of the picture. They're very involved throughout the entire process. So if the client sees something they don't like in the inspection, you know, they can cancel, you know, or they can try to renegotiate. So I think in that instance, if there was something not disclosed, you know, I haven't had this. You guys are good with all these unique questions, but yeah, you know, I mean, we look at all of the inspections and the, you know, the seller transfers, you know, all the seller disclosures, and that's disclosed all to the client, to the buyer, so they see all of this. I feel like I'm making an excuse, like it's not going to happen, but you know, it could happen. Yeah, yeah. So
it's tough to go back to step one there. So in this market, it's a crazy market.
right?
It's a seller's market. Homes go on the weekend and they're gone by Tuesday or Wednesday.
Yeah.
Now, obviously, we needed AVM from you guys, you know, before you make an offer. On top of that, you want to look at the inspections. I mean, can you work in that time frame?
Yeah, yeah. Because it doesn't have to go through underwriting. You know, the underwriting process is the tough process for a normal finance transaction. You know, we have to review all the employment. We have to look at all the bank statements. If the client has transferred money, we got to talk to them about why and where they transferred the money. Where did it come from? We have to get a verification of employment from the employer. You know, there's a lot, you know, the appraisal has to be done. And all of those tasks can be skipped on this one because it's an all cash offer.
You saw the report, as long as there wasn't health and safety issues involved.
Right.
You wouldn't reject the.
Right.
Okay.
Right. Yeah. So this is not for a fixer upper, you know, flip property. And it's only primary residence too. So yeah, it's not for investors. We can use the seller's inspection. Yeah. Yeah.
Would there be any scenarios where the client would make it through pre-approval, but not through the underwriting?
Well, we work very hard to make sure that doesn't happen. So I'll say no, but you know, I mean, we know in real estate things happen, but ideally we wouldn't, if we didn't have confidence that this loan could be done, we wouldn't issue this pre-approval. So.
Let me get back to the inspection again. You guys are okay with just a general house inspection? We don't have to have a termite inspection. We don't have to have
Correct.
a inspection.
Correct.
You're okay with that?
Yeah. Okay. Okay, did I miss anybody? Oh, yeah.
Does that cost anything? Is there a certification that received afterwards?
Yes. Well, first question, no, it doesn't cost anything. And yes, you get I mean, it's nothing special. It's just an email saying, because you are going to be the agent of record on that purchase contract. So we're going to look at that name to make sure you've gone through the training. So, and there's a lot of communication. You're very involved with our group. We assign a person that works with each transaction, and they'll be talking to you, and then I'll be involved as well. Like, you know, the loan officers are involved, and there's a lot of communication that takes place for this program. Yeah. So.
Interesting.
Okay. Yeah, I can get you that. So I think all my contact information will go out, so we can, you know, we can get you signed up for it. Yeah.
Maybe I just wanted to verify something.
Yeah.
And I apologize, I had to step out for a minute, but.
Oh, no.
So you said, although this is available,
the maximum loan you lend to is 1 point, the.
Yeah, 1.143, yeah, yeah, the high balance limit, yeah. Yeah.
Okay, just one.
Yeah.
What
So,
was it, 1 point?
the conforming loan, God, I should know this off the top of my head. It's 1.1, yeah, here in Santa Clara County, and actually most of the Bay Area counties, San Francisco counties, San Mateo, Santa Clara, Santa Cruz, Contra Costa, Alameda. And it's all the 1.143, I think it is. 143, 1,143,000. And then there's a like 820, you know, they always add a little number. It's because it's based on a percentage of the area median income kind of thing. So okay, so that's yeah, hold on. I'll get that. Let me get that for you. Yeah. Yeah. 1.149. There you go. Almost 1.15. Thank you.
Thank you.
Okay. Yeah.
So the seller have to work with you before, right? I mean, you have this, have their property already. So you go out and look for another property. When things go so fast, so like within 5 days,
yeah,
you can have everything done.
Well, the seller, you know, the seller of this property, of the property the buyer is buying, they just receive the offer, just like a normal offer. So we don't interface with them any more than we would on a normal purchase transaction. So they're just going to receive an offer. It's going to be an all cash offer. And as the realtor representing the buyer, I imagine you would be talking with the listing agent on this property and explaining to them, you know, what's going on. But they'll receive a full offer that'll be an all cash offer with a close of escrow date and proof of funds. So the seller here is just like a normal seller. Now, if this client happens to own their current residence, they'll become a seller at some point. And you as the listing agent, you would work with them, but we're not involved in the sale of this property. If the client has a property to sell, like we're not involved in that, other than we want to see the sales proceeds once it closes, because we'll need that money to do, most of the time, that money to do this loan. So does that answer the question? This is a really unique program. It has a lot of moving parts and a lot of details. So I just wanted to expose you guys to it. And if there's more questions, you know, we can go through the training, and I'm happy to, you know, jump on a phone and go over more details.
Sell the property is like a free offer.
Close of which home?
Wants to sell the property after it closes.
Oh, they want to flip. You want to flip this one? Oh, you want to flip this one here? I suppose you could. I mean, it's a primary residence, owner occupied loan. I think really the intent here for most homeowners they're buying the property to live in. Now, if there's some unique life circumstances, you know, job transfer across to a different state, or, you know, something happens like that, there's no restriction for them to sell that property.
There's no prepayment penalty, but you have to be concerned about EPO.
Oh, we do have EPO. But that doesn't affect the borrower. It affects us.
You'd like them to keep at least 7 months?
6 months, yeah.
Can
You guys know what EPO is? Anybody know? Are you a lender, by the way? Yeah. So EPO stands for early payoff. There's an early payoff penalty. And
so there was no issue of us paying for refinance.
Right. No, the client, we take the hit. Yeah. So it's always a struggle. You know, if interest rates, I showed that interest rate chart a while ago, you know, a year ago, rates were in this kind of lower 6% range. Now, if rates suddenly go down to the 5.5% range, everybody that has a 6.5 is going to want to refinance. But if they haven't had that loan, or say everybody that got like a 7% loan, and they've only had that for say 2 months, and they're like, oh great, let me refinance and get 5.5. They can do that. There's no prepayment penalty on the loan, but the lenders you know, the end investor that actually supplies the money, they say, hey, we haven't earned enough interest yet. We haven't made enough money yet, so you guys have to come to the table with some money.
I assume at that point you guys were trying to be the person for refinance, right? I mean, I assume you're not gonna let it go.
Yeah,
right?
yeah.
Okay.
Yeah, and the way that also works, just so you know, this is very insider lender baseball, so hopefully you're not too bored, but they'll take the commission from the loan officer if that happens. So we're not incentivized to do that, but that's just the way the industry works. So if a refinance, the clients, mortgage lending laws are extremely consumer friendly. You know, as long as the client continues to make their payment, as long as the borrower makes their mortgage payment every month, there's nothing can happen. The only time the lending industry can become unfriendly is if the borrower stops making their payment. That's a problem. But if they continue to make the payment, they're fine. And in an underwriting, in a loan transaction, they can cancel at any time without any penalty from the lender. They can cancel all the way up until they sign the, you know, the final note. And they can cancel the day before that. Now, they might lose their appraisal fee, and there might be some ramifications on the contract. You know, they might lose their 3% deposit, but that's on the real estate side. On the lending side, there's no penalty. Of course, we don't like that, you know, and it doesn't happen often. So.
Is there any, let's say that hypothetically, I see a place in Monterey, but I want to sell my house.
Yeah.
Move to Monterey for a month, go through your little thing, whatever it takes. And God, month number 2, I go, man, I really don't like it here. But I'm gonna pick this place as a rental. I'm gonna move back to my primary.
Yeah.
What's the issue on that? Is there a time period that you have to stay in that, make that your primary for? Is there a 6-month period or any kind of time?
So that's a great question. And here are the sort of the gray areas of the way I explain the lending laws. In that situation, the lender's primarily concerned with fraud being taking place. Like the lenders are really concerned with a borrower misleading them. Yeah. Now, if the intention is, hey, you know, don't tell anybody, I'm going to move down here in a couple months, I'm moving back, that's fraud. If it's legitimate, if you move down there and you're like, oh my gosh, you know, I don't like this weather here, and this neighbor, I didn't know them, but oh my, you know, we're not getting along. It's this location's not working for me, but I'll keep the property and I'll move back. They can still rent that property. Yeah. Yeah.
Confirming that any agent can take the training classes, regardless if they have a agent in the program.
Correct.
Okay.
Yeah, we actually encourage that. If you think you're going to be using this program, don't wait till you want to write a contract, want to write an offer, because the programs, they change the training schedules frequently. I think right now they're a couple days a week, Tuesdays and Thursdays at a certain time. If you need an emergency training, like, oh, we got to write an offer and we need to be, you know, we can work with you. But we encourage you to, you know, I can give you the schedule and you guys can sign up. It's like an hour. Yeah. It's not bad. I mean, it's just it's on Zoom. I don't do that training. We have our staff so the way it works with our company, the NAF cash, that's a different department. So you train with that department, you know, we interface with them and they work with the realtors and they, you know, they end up funding the loans. So that it's a separate department that's not part of where I am. I'm a retail loan officer. So I work with consumers, and, you know, mortgage companies like us, we're called small mortgage banks. And, you know, we have underwriting departments that do all the underwriting. In this case, we have a NAF cash department that handles all those transactions. We have a loan processing department that, you know, processes all the loan documents, things like that. So there's a bunch of different, and we have, you know, doc drawers and funding and closers. So there's, in a mortgage company like us, and even large, you know, banks, they have these different departments that handle all the transactions. So, and in this case, NAF cash it's not a separate entity. It's our company, but it's just their own department.
You guys do hard money. Do you have any option for hard money or investors flip or something like that?
I do have a flip program. Yeah. For short term, those rates are not so great, but it's available. And those are usually 2 points. Yeah. And the rates are in, you know, they're 12-month loans. So they're short term, interest only. And yeah, you know, maybe 10 in the 10 to 11. Yeah. So Okay. Thank you for all the questions. This is great. I hope I didn't miss anybody with any of the questions. But, okay, so let's move on. And also, we have like, are we okay on time? I guess you can. I have kind of a lot more I wanted to go through, but
I'm fine with you sticking around and going. I think we did till 11.
Yeah.
But you go ahead. If you're on Zoom, we're recording this. You can stay on. You can have as much time as you'd like.
Okay.
I'm fine with that.
Okay.
I may have to run back to my office, but
okay.
Yes.
All right. Well, thanks. I'm going to go through this next stuff a little bit fast, and just because it's 10:55 right now, and okay. So this is another strategy. Market dynamics, I think, have shifted since so I'm not sure how viable this one is right now, because it's, definitely a seller's market. And if you're working in a situation where there's multiple offers, a buyer is probably not going to have the ability to negotiate a seller credit. And I think that's what this program is, or this strategy is based on. And so what happens is, you can see here, I just want to point out a couple of things. This is for a jumbo loan, so it's a loan greater than that 1.149 loan amount. We have a debt ratio here of 44.48. Okay, what that means is the borrower will not qualify for this loan, so we couldn't do it. The jumbo loan requirements for most jumbo loan programs, you have to have a debt to income ratio of 43%. So we're above 43%, so it doesn't work. But let's say the buyer really loves this property, like this is the right property for us. How do we make this work? And what happens is, if we go to the next one, is we see here, if we go to the top, we notice the debt ratio came down from 44.48 to 41.19, which is less than 43, which means this scenario will work. We could write a pre-approval for this scenario. But why does it work? So let's go through that. The reason it works is because if we come down here and we look at our total closing costs here, this is with impound, so it might look a little high, but we have a discount fee, okay? You notice here, there's 0 discount fee on this one, and here there's a discount fee of $46,080, okay? But then also, we see here, there's a seller credit of $48,000. And the way this works is, if we go to the top, the very top line there, we have a discount fee in this second scenario of 2.4%. So that's based on the loan amount. And when we write the offer, we're going to ask the seller for a 2% seller credit. And that's 2% based on the purchase price. Okay, when we write the offer. So we're going to write an offer. Maybe we write a full price offer. And we say, hey, Mr. and Ms. Seller, we love your property. We want to buy it, but we need you to provide 2% for the credit. What that enables a buyer to do in terms of the loan is buy down the interest rate. And you'll notice that here we started out at 7.75, and now we've brought the interest rate down a full percentage point to 6.75 with that 2% seller credit. And that's a very rough rule of thumb, by the way, just if you need to keep some kind of numbers in the back of your mind, is if you can get a 2% seller credit very roughly, it's not exact, I can't stress that enough, but you can roughly buy down the interest rate 1 full percentage point. But what that does is that makes their interest rate lower, which makes their monthly payment lower. Their monthly payment goes from $16,400 to $15,100. Now they qualify. So we can write a pre-approval for this offer, because our debt to income ratio is less than 43. And then the one other really cool aspect about this, and by the way, let's look at the impact to the seller. Okay, this is really important. And this is why this is a little bit more of an advanced strategy. And again, just because of market dynamics, I'm not sure how viable it is at this time, but this is how it works. In scenario 1, the seller gets a full price offer, 2.39, almost 2.4. And then the seller, they net they don't net, but their net, I guess, sales price is 2.399, 2.4. But if we ask for a seller credit, we're going to take $48,000 off of that. So the seller's really only going to end up with 2.351. So the seller might say, I don't want to do that. I have to give it. So, sorry, but I'm not going to accept your offer. So here's another way to structure it. And I'll point this at the bottom here. And we say, I'll point this out first. With this structure, the seller's coming in with $49,000, or the seller's providing a credit for $49,000. But look what happens to their net sales price. They're getting their original offer price, 2.401. a little bit higher. Now, why does this work? Well, let's go back to the top. We can see our debt to income ratio in this third scenario is still below 43%. So that works. So what happened here? Why does the seller get all their money, get the full offer price? It's because look at our purchase price. The 2.3999 is the list price, but we're going to come in as a buyer and we're going to say, we're going to offer you 2.45. We're going to offer you a little higher. We're also going to ask for a 2% credit, and that's going to help us qualify and successfully get the loan to buy your property. And look, there's no, you're not really giving up anything. So this is, I would say, a very advanced strategy because, you know, the idea is there's a lot of moving parts here. And if the seller's receiving multiple offers and blah, 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 this probably is, they're not going to entertain this. But if you have a property that's lingering on the market, and this is a way for a buyer to potentially buy the property. And the first question people usually ask is that, you know, we have to appraise for that. We have to appraise for that, you know, 2.45. So that's part of the discussion as well. We need to make sure the comps are there for a buyer to actually offer higher. So that's another little advanced strategy. And if you're representing buyers and working with sellers, like I can help you walk through these numbers each on an individual property, you know, this is actually a really old strategy used back in, like I did this all the time back in like 2010, 11, and 12, where FHA was still a viable loan program around here, and you would negotiate a seller credit to cover all the closing costs. So we offer a little bit higher, the seller gives us the closing costs. And we got that on some short sales back then too. So, okay. Okay, so the next thing I was going to talk about, and we're over time here, so you guys can tell me if you want to hear about this, but this is, down payment assistance programs. So California, the DREAM program, I think we're probably familiar with what happened last year on that. The funds just evaporated almost immediately. So California's they've issued a notice. They're going to start doing phase 2 of this program. So last year was phase 1, this is phase 2. So they originally allocated $500 million for this program. And last year they released $300 million. And we know that $300 million got used up in a matter of days. And so there's $200 million left over. So for phase 2, we have $200 million left over from phase 1. And then the state appropriations budget for 23-24, they actually dropped in another 20 million, okay? And then phase 1 fallouts came to about 35 million. So about 35 million didn't close from phase 1. So for phase 2, our total allocation with this Cal HFA Dream for All program is 255 million, okay? And here's what they're doing. This is what they're doing. I'm gonna actually walk over here. You know, last year the program ran out so quickly, Cal HFA made some changes to hopefully make the funds last a little bit longer. So they've broken the state up into these geographic pools here. And this first column, you can see that for the fundings, if you look at the Bay Area got 19% of the fundings last year. So, you know, pretty good amount. But look at what happened with Los Angeles. I mean, a massive population in Los Angeles, right? But they only received 9% of the, phase 1 funds. So this year, what Cal HFA did is he said, all right, we're going to give Los Angeles 25%. And if you look at the capital region, which is the, Sacramento area, they got 16% of the funds. And so this year, Cal HFA said, all right, we're going to scale this back to 6%. 6%. And then the Central Valley got 21%, and they came back to 10%. Bay Area, our area here, we're getting a little bit more this year, which is going to be 21%. Now, the way they're doing this is, and I'll explain more about this as we go through, but the new program is going to be issuing vouchers to the applicants. And there's going to be a randomized selection process for who can participate in this program. But I did some rough calculations based on some of the estimates, and I think we're going to get in the Bay Area about 420 vouchers for this program. Okay. And let's see here. So, this is kind of boring, but the max loan amount on this, so last year, the max loan was 250,000. This year, it's only 150,000. So if we take the 255 million that we had allocated for the program this year, they expect to help about 2,000 homeowners statewide. So if we just do a simple division, we get the average loan amount on this program would be 127,500. Okay. That's not that important, I don't think. So here are the income limits. So last year we had not statewide, but actually I think it was statewide. It was like 327,000, I think, for the limit, the income limit. Really generous. They've dropped those, but it's still, I think, pretty generous. You know, in Santa Clara County, the income limit is 287,000. So if the applicant, you know, the borrowers and buyers make more than 287,000, they won't qualify for this program, or they're not able to use the program. But I still think this is really generous. Just looking at the income and calculating debt to income ratios, you know, with this income and some of the other requirements on the program, this program will work with up to like a $1.35 million purchase. So, you know, kind of our first-time home buyer price in our area. And here's the one big, huge element to restrict the funding in this program's this year. So what this is last year, the buyers had to be first-time home buyers. This was only available to first-time home buyers. This year, at least one borrower on the loan application needs to be a first-generation home buyer.
Parents own the house, you can't get this.
Right. So that's the hard part. And the biggest question, this is a quote from the guidelines. To note, you know, if the borrower has grown up in the foster care system, they automatically qualify regardless of if their parents own a home or not. So the question is, how are they going to enforce this? I mean, yes. So if Mike Smith says, hey, my parents didn't own a home, how are they going to prove that particular Mike Smith's parents, you know? It is fraud. And the borrowers are going to have to, I don't know if it's going to, Cal HFA hasn't released the exact procedure, if it's going to be a form or what it is, but they're going to have to attest under the penalty of perjury that their parents have not owned a home. And in anywhere. Well, no, okay, so that's another one. So the first generation home buyer has a 7-year limit on it. So let's say the client's parents didn't own a home, so they're first generation home buyers, but they owned a home 5 years ago. They won't qualify. If they owned a home 7 years ago, then it's okay. So it's 7 for the first generation home buyer, and this is a little technical too. So if we have 2 people on the loan application, both people have to be first-time home buyers, not owned a home in 3 years, but only one person on the loan application needs to meet this first generation.
And the money's
yeah, did you step out a little bit? I think, yeah, so yeah, there's it's 150,000. Last year it was 250, but this year you can get up to 150,000. Okay. Now there's 2 this is the same as last year, but I'll just go over. There's 2 education classes required. And I'm not sure how familiar you are with the way the program worked last year, but it's an equity appreciation sharing program. So the clients need to take a regular homebuyer education class, and they also need to take this shared appreciation class. Now the shared appreciation class is very easy. It's about an hour long. It's free, and they can do it online. There's a link on the Cal HFA website, and I can send it to you guys if you want to know. This first one is not free. This is like the 8-hour HUD homebuyer education class. This first one here, you can take it. You know, there's lots of facilities that put these classes on. So you can do in person, you can do just straight online where you're clicking through, or you can do like a Zoom class. So it's pretty flexible. So, with Cal HFA. So the way it works is
they recycle that money.
They recycle that money. Yeah. The appreciation, the amount that they earn from the appreciation goes back into the pool to be lent out the following year. Yeah.
They sold the house, refinance.
Yeah.
Is that money, that down payment is that a loan or is that a grant of some kind where they pay it back you to share the appreciation?
Good question. Yeah, it's a loan. So it goes in, remember we talked about lien position. We have the first lender in Cal HFA, the down payment assistance is going to go into second position. So let's say it's 150,000, the limit, that'll go into second position. There's no interest rate on it and it does not, so it doesn't accrue interest and there's no monthly payment associated with it. But there is the appreciation share component. So if the down payment assistance equates to 20% down, Cal HFA wants 20% of the appreciation. So let's say they give, I'm gonna make the math easy. Let's say the down payment assistance is 100,000. And then let's say actually we can do it. So let's say it's 150,000. And let's say by the time the client either sells or refinances home, by the time they want to pay off that 150,000, there's $100,000 in gain in the property, 100,000 in appreciation. 20% of 100,000 is 20,000. So the client would need to pay back, or the homeowner would need to pay back the initial 150,000 plus the 20,000. So they're going to give Cal HFA 170,000 in that example.
Yeah. I think it sounds like that's important. Do that shared appreciation, but if you stay in the property for like 15 years, that went away.
Well, I'll talk about that one. I do have that one on the list here to talk about. But this one, it's a 30-year loan. So the down payment assistance loan is a 30-year loan, so that it can remain in place for 30 years.
What if you moved out with the place?
Oh, Cal HFA they're very strict about that. It's primary residence. I mean, again, going back to the fraud thing, like, can you get away with it? I don't know, but yeah. So you'd want to pay that back. But, the idea here is this, is if you're going to be using this program as a first-time home buyer, it behooves you to pay off that second loan as fast as possible. Because as soon as you pay it off, you don't share any of the appreciation after that as time moves forward. So if you're in a position where, the property has gone up in value and rates come down and you're able to do a cash out refinance and pay that off, it'll be hard at first. It won't be very nice. You have to pay.
I know there's a program called Rex a long time ago.
Oh yeah, Rex. I remember them. Yeah.
They had a factor that if you did work on that property, do some kind of update on the property, they did an appraisal, they give you a value.
Oh yeah, I think they do that here too. Cal HFA will do that. If you can provide invoices for the cost of kitchen remodel, they won't take that out. Yeah, yeah. So it's strictly just the appreciation, less any capital improvements. Yeah.
Start to finish.
I'll kind of get to that. So let me move on. The way this program works. Okay, so here's how this will kind of bring it all together. So we've already seen some changes. They're going to take the loan amount from 250 down to 150 and different income limits. But what happens is, to start the process, what we do as lenders, and by the way, New American Funding, we're a Cal HFA lender, so we can do all this. We do a normal pre-approval. Okay, so we look at the client's credit report, paychecks, bank statements, all that. And then we go to the client and say, hey, take the 2 classes, and then they're going to send us the certificates of completion on those 2 classes. And then what happens is we're going to issue, Cal HFA has a form, they send it to the lenders. It's a special pre-approval letter. It's branded Cal HFA Dream for All. So we fill that out and we give it to the client. And so the client says, okay, I'm approved for Cal HFA. What Cal HFA is going to do is sometime in April, they haven't released the date yet, but sometime in April, they're going to open a registration portal. The portal is going to be open for 25 to 30 days. And so everybody that wants to participate in this program needs to have that pre-approval letter from the lender. And then once this opens, they need to register. Okay. After registration closes, Cal HFA is not taking any more applicants. So it's critical. Like, we're already doing pre-approvals here because Cal HFA could announce tomorrow, hey, registration's window's going to be open in March. We don't know. They've said probably April, but yeah, so they need to get into this window and need to register. Now, once they register, they'll register in the portal, and then the portal's going to close, so there's no more registrations. And then Cal HFA is going to do a screening for eligibility. I imagine the big part of that's going to be that first generation homebuyer component. They're going to look at all the pre-approval letters that they've received and make sure all those people will qualify. And then Cal HFA is going to select homeowners based on, and this is the language they used, a randomized selection process. I don't know what that means, but they're going to select everybody that's in the registration system. They're going to select based on those vouchers. Remember that one slide I showed with the numbers of vouchers available in those geographic pools? That's how they're going to distribute the clients to different geographic areas. So if the buyer is selected, they're going to receive a voucher. Cal HFA is going to give them a voucher. The voucher is going to have a number, and they need to give that voucher to the lender, to us. And then we will register that number. In Cal HFA has we call it a NAS system. That's what we use to reserve funds. But when we get the voucher back, we will reserve the funds for that buyer, for that client. And then they have 90 days to get into contract. They don't have to close in 90 days, but they have 90 days to get into contract on a property to use this program. And if they're not able to secure a contract by that time, their voucher is rendered void, and they go into a waiting list. They go back into the randomized pool selection, and they'll be put on a waiting list. So,
and how much money is available?
This one was 255 million. So last year it was 300 million.
How quick did it go?
Last year it went out, I think it was like 6 business days. I mean, it just went like that. So it is viable. It will work if you can get a voucher. Like I did some calculations. You could purchase up to like a 1.35, I think I did. So a 1.35, $1,350,000 property, which is kind of, our starter home, in this. So it will work, and it works for condos as well. The hard part's going to be to get the voucher. Yeah. And if you're a listing agent and somebody's saying, hey, if they submit you an offer with, 20% down payment assistance, you're going to want to see that voucher. You're going to want to talk to the buyer's agent and say, hey, I need to see their Cal HFA voucher before I accept this offer.
Actually, last year, how many people actually applied? How many got it? We did.
Yeah, so it was roughly, I think 2,700 got it last year, received it. Yeah. Oh, that I don't know. Yeah, I don't know how many applied. But so the program last year was we call it first to counter. It's just like, if you're the first to the counter to get your down payment assistance, you got the loan. This year, it's not that way because there was no voucher system last year. There was no randomized selection process. It was just, if you're in contract and you want the funds, you got them. And that's why it ran out so fast. So this is the system that they've implemented to slow that down, to make it available for more people. Oh no, the parents, that's interesting. I kind of nerded out on this. I read the meeting minutes from the state, the Cal HFA meeting when they were proposing this program last fall. And there was a line in there. They said, oh, we can make it as long as the parents didn't own the home in the last 10 years, then we can consider the buyer first generation. But they took out that 10-year period. So I think it's ever right now. So if your parents have ever owned a home, you're not considered a first generation home buyer. And I've had the question, people say, well, what if they owned a home in Germany? Like, well, I don't know. You could probably get away with saying we haven't owned a home in the United States, kind of thing. So anyway, so that's the new program. Like I said, it's not going to be available. That registration window is supposed to open in April. And by the time they do the randomized selection process, I don't think we're going to see home buyers using this program till the summer, really. But if your clients are talking to you about it, this is the process. And we can start doing the pre-approvals. I've already done several of them. So, okay. Oh, and then one other thing here, Cal HFA specifically said, that window is going to be open for 25 to 30 days. It doesn't matter if you register on the first day or the last day. There's no priority. As long as you register within the window that it's open. you have equal opportunity to get a voucher. Okay, so this is the next down payment assistance program. And this is the Housing Trust of Silicon Valley. And I think, Ruben, this might be the one that you were talking about. This is available for people that live and work in Santa Clara County only, okay? This one is really generous in terms of the amount of money that they give, but it's really hard to qualify for. But it is available. They have two programs. They have the HELP program, the Homeowner Empowerment Loan Program, that's HELP. And then they also have this Empower program. Now, the Empower program is similar to the CalHFA program from last year, in that it will give up to $250,000 for first-time home buyer. There's no first generation requirement on this one. It's just first-time home buyer. So to compare the two programs, there's the Empower program, there's the HELP program. Empower will provide up to $250,000 or up to 30% of the purchase price, okay? Whichever's lower. And the HELP program only provides 10%, and they have a price limit of $800,000. So the HELP program is not so viable in our area. It's, maybe if you can find some condominiums or, I mean, Santa Clara County is a huge geographic area. So you might be able to find some 800,000, but the HELP program it's difficult. We don't see that used very often. But this one can be used, the Empower program. The Empower program has no maximum purchase price range. Empower program, the maximum, they have income limits, and that's based on 120% of the area median income. The HELP program has a little bit higher income limit based on 140%. First-time home buyers, with this program, the buyers have to come in with at least 3%. So they need to contribute at least 3% for either of these programs. And then there's some credit score requirements there. Minimum credit score. And here's the income limits. So these are the 2023 income limits. So they went up slightly this year, but they're pretty much the same. And they base the income limits on the number of people in the household. So if you have, a couple with maybe 3 kids, then that would be considered 5-person household. Okay, so that's how they do the income. So as long as you might have 2 income earners earning this amount. If they earn more than that, they won't qualify. But it is based on the number of people in the household. And this is the hard part for this program, because a lot of time you might have some, say, young adult people living with their parents, but they want to buy a home. Unfortunately, the Silicon Valley Housing Trust counts the income from the whole entire household of that kid, that adult child. So if the adult child says, no, I'm going to buy a home and I'm going to live in it myself. It's just going to be me. So, this will be, but I don't make this much, so I should qualify. But if your parents and maybe a sibling or something all make more than this within the household, if there's a 4-person household, they won't qualify. So that's a real tricky one. If you have a client who wants to do that, they live with their parents, and it's like, okay, move out into your own apartment, go rent an apartment, for a couple months, and then we can see if we can get you qualified. Yeah.
If you're living with mom and dad, they're gonna look at their income and yours, even though they're not moving in.
Correct. It's so strange. I've gone to a couple of training programs on this, and that's the way the investors that are supplying the money for this program, this is just their guidelines. So, sorry.
Is that direct family? Like, let's say you rent a room from a family friend and wanted to do this type of program, would that count against you? Or
that's a good question. I think if you rent a room and we can show with a lease agreement that you're just renting the room and it's not part of your family, I think that would be okay. They would only count your one income. Yeah. But if I had that situation, I would definitely send that into the housing trust and ask them. Okay. Yeah. to make sure it's okay before we move too far down the line. Okay. Let's see here. Oh, that's it. That was my last one.
Okay.
That was it, guys. Yeah. So.